Hi everyone, welcome back to Be Rich. As I was saying yesterday, we were talking about what the Chinese are doing to, fight the dollar and dollar dominance, thanks to what happened with Joe Biden and now Trump. First weaponizing the dollar and now the tariff wars. This same reflection you can see also being seen in gold and the way gold move. What we're having are short-term pain in gold and long-term strength is what most analysts feel. What do I mean by short-term pain? We saw one of the largest one-day drops in gold prices just recently in the last 12 years. Yet, if you study history, which we all of us should, like Anand always says, if you want to be a great investor, you should study history and philosophy. And in history, if you see, gold typically falls alongside equities during stress, then decouples and outperforms once liquidity returns. So what does that mean? When there's a lot of stress in the market and equity is under stress, typically gold and equity fall down together. And then when does it decouple? When does gold start rising again? Once liquidity returns. And this is a major data point which we are able to see. So the last 6 major S&P 500 drawdowns, which is more than 15%, gold initially fell, but then outperformed by 40 percentage points by the time equities bottomed out. So in 4 of those instances, gold produced absolutely positive returns. So what is the mechanism? During a panic, investors sell liquid assets such as gold to raise cash. Why? Because they've taken positions which they can't afford to be in, because they did not expect the market to turn sour. So what do? They sell these positions and they use their cash from gold to do this. This happened not only in the stock market, this also happens when in any market, even the cryptocurrency market. So all of this has a knock-on effect on what happens in gold. You saw the rallying happening, then you saw a sudden correction happening and people pulling cash out of gold for these kinds of pressures which appear for them in the market. Like Anand said in the previous couple of videos about silver, how people have taken positions in silver, especially in India, and about the short squeeze in London. And he is even warned, saying the short squeeze has not ended as yet. So be very careful if you're taking positions in silver. If you do have positions, especially leveraged ones, he says you must consider exiting those positions. And especially if you're in profit, you definitely should. If you're at loss, it's better to cut your losses now than suffer more pain. So this is what happens during a panic situation in the market. That's a mechanism one. Second, as central banks cut interest rates, risk appetites wane, and gold rallies again. So this is what Anand again has mentioned. So you can see this happening with the Fed looking at the inflation data. Though it's at 3%, they feel it has not progressed as fast as they expected. That means it's cooling off. Then we can expect it to fall sooner than later, so we can cut interest rates. And they're expecting the central bank to do it twice before the end of the year. And if that happens, that adds more liquidity in the market, pushing gold prices further up. Central banks right now, holdings of gold is 1/3 of global reserves. And they are continuing to add holdings to hedge against the dollar assets. So why is that happening? Because, like I explained in the previous video, the Americans have decided to weaponize their currency. And this has led to not only China taking action, it is leading to all central banks across the globe to take action. They don't want to be in a position where they have to be answerable to China either. So every central bank and country would like to strengthen its own currency and position by piling on gold. Because there's a long-term shift which is happening, which is the fiat credibility and low inflation stability both being questioned. Gold seems to be the only way of being a defensive commodity in a quasi-monetary anchor. So what does that mean? That means, like I said in a previous video, when Nixon decoupled from gold, that's the first time human beings actually moved away from gold. Before that, we were tied to the gold through paper. That means the dollar was promised that so much gold is backed by each and every dollar. To print as much currency as they wanted, they decoupled, and that's when you saw gold prices soar through the roof. From there, there's been no turning back. Now, this experiment is slowly winding down to an end, as globally speaking, more and more countries and people are slowly looking at piling onto gold as a safety. Why? Because historically speaking, gold has a long history and has always been something human beings have allowed to. Why, we do not know, but we have a fascination towards gold, and that still remains. So in this transition period, when there is confusion, there is no idea on where we are heading monetarily, globally, as trade is right now. The best thing to do is to be safe. And best thing to do to be safe, as Anand used to say, poor Indians, middle class Indians in India don't have any option but to turn to gold in the past. That we used to keep all our family assets in gold because we didn't have a choice, because that is the only thing that was accessible, because we didn't have really faith in any currency. This is happening for countries too on a global scale. Countries are losing faith in the global order and they're losing faith in global systems and reserve currencies. So what do? They abandon the reserve currencies and move to the gold, which is what we human beings do on an individual level. This is happening on a country level, on a global level. So why am I saying this draws parallels to what I was saying about yesterday? There's an emerging pattern happening here. First, the trigger, the China's renminbi push. The reaction is because of the weaponization of the dollar in the gold market. It's a loss of faith in the dollar and the assets during crisis. So what is the objective for this China renminbi push? To build an alternative payment system, global system for a funding system for the Chinese themselves. Like I said, in the global market, which is a preserve value outside a fiat system, which is the dollar system. Dollar is also a fiat currency. Instruments, trade finance, cross-border lending, the bond connect is what the Chinese are hoping for. Here in the gold, like I said, central banks are wising up to this. So they're saying, hey, we don't want to get out of being with Big Brother 1, get to Big Brother 2. So let us try and be independent and pile on to gold ourselves. So what is the impact? For the Chinese, it is trying to gradually create a multi-currency system for the central banks to reinforce gold as a neutral global collateral. So if we are going to have something which we're going to be working with, central banks around the globe are saying, let it be gold. That way nobody can create it, nobody can demand it, nobody can use it to be weaponized. So historically, if you see this happened in the 1970s when the resurgence of gold happened when the dollar shock. Same way, these patterns are emerging to show this decoupling happening. So is this going to lead, to complete abandonment of the dollar immediately? No. It's not going to happen anytime soon, but the cracks are showing and you can see a pattern happening here. And this is what's been fueling what you're seeing in gold, and this is what's been fueling what you're seeing happening with the Chinese. They seem to be doing a very slow dance with the Americans as they're trying to negotiate this process. Once they feel they're in a position which is far more secure as far as their trade is concerned and their renminbi is concerned, then they might get more aggressive with the Americans. This is something interesting to wait and watch to see how the Americans handle this, how the Chinese handle this, and of course the rest of us handle this globally. So as far as gold prices are concerned, I see there is more room for it to go northward than southward. So if you need gold, if you have a requirement for gold, in the next year or so, I would strongly advise you to do the purchase when you see these dips, so you can consume the gold as you need for the next year. But as an investment class, like I've said, picking a great stock at a great price will always outperform gold in the long run. If you're comparing it to an index, yes, gold is outshining. But if you compare it to individual stocks, I still think individual stocks are better. Would love to hear your opinion. Drop it down in the comments below. And tomorrow I'll try and get Anand back in to have a conversation with you again about something interesting from the world of finance and investing. Thanks for being with me on Be Rich, and see you tomorrow from Chennai.